Welcome to the Power and Market Report. I'm Albert Liu. I have a real treat for you today. Whitney George is the chairman of Sprott U.S. Holdings and the portfolio manager of Sprott Focus Trust, a disciplined value-oriented fund. Whitney was recently featured in the December issue of Value Investor Insight, and he joins me today from Darien, Connecticut. Hopefully staying warm. Whitney, how are you?
I'm fine, Albert. Happy New Year, and yes, we're in the middle of a winter blizzard here in Darien, and unfortunately, it's a lot of snow after I spent a week out in Jackson Hole, Wyoming, where it didn't snow. So, I guess I can't complain. I'm here. I'm warm. I'm inside. I wish I was skiing.
Yeah, well, kudos to you for making it into the office on what's definitely a cold and tough day. I want to talk about this article because I thought the interviewer just did a brilliant job. I always enjoy a good interview. They're hard to find, and I think this gentleman did a fantastic job with you. So I want to touch on some of those points after we talk about some broad issues. We just finished 2017, another unbelievably good year for the broader U.S. equity market, Whitney. S&P up over 20%. What are your thoughts about 2017? How would you characterize that year?
Well, you got to characterize any year where one achieves double-digit returns as a successful year. Again, we're not so concerned the way we manage money with benchmarks as we are with absolute returns. And by absolute, I always like to stress that's after fees, that's after taxes, that's after inflation. So, Focus Trust's NAV was up about 18.5%. That's a little bit behind the S&P, but it's a very, very satisfactory result as far as I'm concerned, particularly after the very strong numbers that we put up in 2016. And frankly, I think it's a continuation of a return to the discipline that I employ working again. And again, there were 5 lean years or so, to refresh everybody's memory, sort of 2011 through 15, where buying high-quality companies with strong balance sheets and that were well managed was not an advantaged approach to the market. That seems to be turning, and I think if you had to look at one thing, it's the potential or continuing normalization of interest rates. The discount mechanism coming back, capitalism starting to work again, having been suppressed by zero interest rate policies. Now we still have an awful lot of stimulus going on, but again, I think what you've seen is a continuation of a return to what I would regard as the historical normal, as opposed to the new normal.
Make some good points there, Whitney. The headwinds that you faced as a value investor. For several years, it seems like the environment has favored, first of all, passive investing over active, and then growth over value. Let's talk about what lies ahead in 2018. We have potentially more rate hikes coming, perhaps the beginning of a global tightening cycle. Do you think that any of this is going to favor a rotation back into value? And do you think that people who are invested passively will once again turn to active management as a solution?
Well, that's a very interesting and large question. We're now well into coming up on 9 years of bull market. Value managers tend to be risk managers. When you start to manage risk, that means you give up some of the upside for a little less downside. So as long as this market continues going up, I think the passive strategy is going to continue its momentum. It's really going to be the first major correction where we'll find out whether or not that's a forever phenomenon or whether that is a phase that we are moving through. My suspicion has been and will continue to be that when risk management becomes beneficial again, people will hire active managers as opposed to chasing the momentum that one gets from owning just the S&P 500 or some other passive kind of vehicle. So I think they work hand in hand. I think for value to outperform, you need a a more normal environment, that means 15% corrections come about once every year to 18 months, and that's when the value investors make up a lot of ground against just owning the S&P. It's the drawdowns that really count the most. And if one believes we're in a new world and you're not going to have those again, people like myself are going to be increasingly lonely. But I don't think that's the case. I think there's a lot of opportunity, for a normal corrective process to occur on any kind of news event. I'm not projecting a slowing economy. If anything, I think the tax bill that was passed is very supportive of corporate profits and can go on for some time. I guess I've said all along, no matter what you think of Donald Trump, wherever we're headed, I think we're going to get there faster. And I think this tax plan may accelerate growth in the short and intermediate term, but may have some expenses looking a little bit further out. But for now, the fact that value investors are participating and that value is at least not being crushed by growth strategies at this stage is very encouraging.
Whitney, I want to go back to a point you just made earlier, and that is when you have these long periods without the large correction that the market is prone to, what does that mean to the disciplined value investor? Does that mean you're going through long periods where you're not acting? What are you doing during that period?
Yeah, it requires an enormous amount of patience. And again, this has been about as long a run as anybody can remember without a corrective, moment. I don't think that the market has declined so much as 5%, for all of last year. Again, people tend to extrapolate recent trends to illogical conclusions, and this has been a very, very long trend. So I think the risk is that when the day comes that the market decides to correct a little bit, it could catch a lot of people off guard and surprise them, and maybe even shock them. I mean, being average, which is what you get by passively investing, is pretty good in a bull market. But when the numbers turn red, average isn't going to be fun anymore.
Okay, I want to get your take from a value perspective on a couple of things that we might be seeing or have seen recently. I want to know if it's signal or noise, if it's stuff or fluff, how it affects you one way or the other or not at all, Whitney. Let's start with interest rates. Like I said, we appear to be entering a period of global tightening. Perhaps we'll get 3 rate hikes next year. Is that good, bad, or neutral for the value investor?
Higher rates are better for a value investor. Buying lower valuation stocks and not paying for growth out to 2030, such as some of the FANG stocks, is obviously going to be better for value investors. The rising rates creates a discount mechanism that tends to make investors focused a little bit more on the shorter term and underlying values as opposed to the very long term, growth prospects. I mean, if you have zero interest rates, the discount mechanism is zero, which means what you earn in 2030 counts as much in a discount model as what you earn next year. And a rising rate environment will reverse that. The binoculars come off, and the magnifying glasses come back on. So that I think will be very helpful. I don't know that we can really withstand a global tightening of any major magnitude because there is too much debt in the system, and it has continued to build. And we've just thrown another $1.5 trillion over the next 10 years onto the deficit with this tax plan. And who knows when we get to the budget process for the next 18 months, what that will add up to. So debt levels are going up, deficits continue, if not are accelerating, and supply and demand would suggest that is going to make it very difficult for bond investors, or be very difficult to keep interest rates maybe even where they are now. The other prospect, opportunity, risk out there is a pickup in inflation. And again, we have typically focused on more hard asset kinds of themes in the portfolio, not just precious metals, but industrials as well as energy. And they were underperformers last year. That may be in the process of reversing right now. So There is some mean reversion that can take place that a value investor can avail themselves of, and that's kind of what we're hopeful in 2018.
Whitney, I've read before that you look at sort of a 5-year time horizon when you're evaluating earnings potential. Do you change your time horizon when interest rates start to tick up?
No, the time horizon is 3 to 5 years for any investment. That allows me to arbitrage time to my advantage. I think it's a lot easier to generally figure out what's going to happen in the next 3 to 5 years than the next 3 to 5 months. Like Warren Buffett, my favorite holding period is forever. But obviously, as a value investors, stocks when they come into favor and get fully priced need to be trimmed to manage the risk so that they can be repurchased when the market's a little bit sour on them.
Okay, let's move on then to taxes. Again, good, bad, or neutral for the specific companies that you follow. How do you see that playing out?
Well, they're good. It's generally good. It's good for several reasons. The portfolio is tilted towards smaller and mid-cap stocks, although there's some large ones in there, as you're aware. They all have strong balance sheets. There are many who have money that can be repatriated. There are many that are full 35% plus state taxpayers that obviously will enjoy greater profitability. It doesn't change any of my valuation metrics because I tend to look at operating income, that's before taxes, to normalize between businesses and industries and sectors. So from my standpoint, the fundamental values remain the same, although the rest of the world may look at these companies quite differently because they get an immediate profit boost from a lower tax rate or more cash available to share with shareholders through repatriation.
Okay, and then obviously it's the larger names that you hold that have those big stashes of cash overseas. Do you have an opinion on how, I guess, this excess cash should be used? Is this a time when companies should be investing, or is this a time when they should be returning equity to investors or retiring debt?
I think nothing has changed from my standpoint there. What you'd like to see is companies to invest free cash, back into their businesses if they can achieve accretive returns. If there's an opportunity to build a factory that over the long run is going to grow your business and enhance your profitability, you should do it no matter what the circumstances or the tax rates. Now, a lower tax rate creates a lower hurdle rate to achieve those higher returns because you're keeping more of it. On the other hand, if a company cannot find reinvestment opportunities in their business, I would prefer that they return it to shareholders, which in the case of my portfolio has been the norm all along. And that return to shareholders should come in the form of either or buybacks and dividends. And many of the companies I own actually use special dividends on occasion when it makes sense mathematically.
Okay, I want to go to the next topic, that is the weakening dollar. Whitney, 2014 was the last time the DXY dropped below 90. We're on a downward trend. If we revisit that threshold, what does it mean, again, for your specific holdings?
Again, to the extent that we have some commodity exposure, obviously, that increases the price of the commodity and the earnings of the companies, whether they're in materials, precious metals being a component of that, or in energy. And if they're exporters, clearly, that's advantageous. But I don't spend a lot of time thinking about the dollar. I think it's a bit of a race to the bottom among all major currencies. Sometimes we'll be declining faster than the yen or the euro, but trying to make a relative judgment and adjust the portfolio for those factors is something way beyond my pay grade.
Okay. Let's talk about the selection process. When you look at Focus Trust, we just mentioned it earlier, you have a very interesting mix of companies. You started in the small cap area, but now you see names like Apple, Exxon-Mobil, Microsoft. What is the thread that ties all of these names together?
absolute valuations. So I've spent my life, being a value investor, and of course, well, at Royce for 24 years, looking at microcap and small cap stocks. In 2009, we had a moment, much like we had in 1991, where you could get absolute valuations, in the largest companies, and did not need to go kind of down the food chain, into the microcap world. In some cases that's persistent. Apple is still not particularly expensive. It's probably not even fairly valued at this point. It may have something to do with its sheer size. But again, that's the anomaly of this bull market is that we haven't really gotten to the normal kind of lineup where one would have to dig very, very deep to find the kinds of absolute values that I would like to have in my portfolio, and that would mean going further and further down the cap spectrum. It's still you can find values in large caps, small caps, and micro caps. Another part of the portfolio or another factor behind the portfolio's weighted average market cap rising is the success of some of the small companies that I've owned for a very long time, who have now become mid-cap stocks and some even large-cap stocks. It's a rare phenomenon that a company can remain public, a really good company public, for as long as some of these have, without being acquired along the way. And one of the curious things about my portfolio and my discipline is that typically by this stage of a bull market, many of the best companies that I own either left the portfolio through valuation or through M&A, and there's been virtually no M&A. Actually, I think last year was one of the first years I can ever remember where not one of the companies in my portfolio was acquired.
Do you have any thoughts on why that is?
Again, I think it's either the slow motion effect of the recovery that we've had, and the prolonged process. And part of that was the effects of 5 years of zero interest rate policy kind of put everything on hold. My guess is that even though the bull market is very long in terms of duration, it's sort of not that much further than sort of halfway along in terms of what you would normally see. It's very difficult for large businesses to grow, and so it's very typical for them to acquire some of that growth by buying smaller companies and smaller competitors, and that just hasn't kicked in yet. That's also probably been the same factors that have led to kind of reduced capital expenditures, because when you make an acquisition, essentially you're making a decision to buy versus build. And I think now with the new tax law and with a more conviction or confidence in corporate America, M&A activity will pick up, and I would expect that will become a more prominent feature on how our portfolio makes its returns from here until the next bear market.
Okay, I got one more question for you, Whitney, at least one more. One of the things I love about this job is sometimes I get to ask really smart people some questions of personal interest. And you have, like I said, a variety of names in your portfolio, spanning on the one end growth names like Apple that everyone knows, going down to names that most people have never heard of. One of those investments is Cirrus Logic. That happens to be a name that I'm very familiar with, having designed ADD converters for 10 years of my career before coming here. And I'd like you to make the case for Cirrus Logic.
Sure, I'm happy to do it. Interesting company. I think it might have been my best performer in the portfolio or largest contributor both in 2015 and 16, and then was a laggard, took a break in 2017 because Cirrus is handicapped by their own success. Their largest customer, Apple, can account for as much as 80% of their business. And until a couple of years ago, they were so busy working on long-term projects with Apple. This is all around sound, converting analog to digital and then back to analog. And all of the features that you get that use voice data, and there'll be more and more of that, are performed by Cirrus. Microphones, amplifiers, all of the kind of sound componentry that goes into not only an iPhone, but it's gone into many of the higher end kind of sound systems. So because of their exposure to Apple, they're handicapped. People view their success with Apple as a risk, and don't give them kind of full credit for it. Furthermore, because of the proprietary work they're doing for Apple, they can't talk about it. So it's very hard for analysts to get kind of any comfort with forward guidance when they're prohibited from talking about their product roadmap with their biggest customer. Now they've fixed that. They made a very good acquisition several years ago of Wolfson, which is essentially a competitor of theirs who served the Android ecosystem. They're now in all of the major handset manufacturers, and the product opportunities in front of them are enormous. Just think about anything that it requires voice recognition or activation in the Internet of Things. They have the engineering talent, technology. It's an extraordinarily well-run company, but they lack the visibility that the sell side on Wall Street likes when making their projections. So no one really gives them any kind of credit for anything other than what they have just reported, and everybody always worries about their reliance on Apple. But their reliance and success with Apple is because they're so good at what they do, as opposed to some sort of captive. If you look at the margins that they earn from their largest customer or across the board, that would imply that this is not at all a weakness, but very much a strength from a technological standpoint.
One thing that I've wondered for some time, Whitney, is how people, asset managers and analysts who are not technical, assess engineering talent. When I was coming out, a lot of the best talent was going to Cirrus Logic, and then there was a portion in the middle where a lot of it, during the tech boom, a lot of it left. And then over the past few years, I've been seeing it go back. I have a lot of personal contacts there. You as an asset manager, how do you assess engineering talent?
Well, you can't really assess it other than watching a company over the long run, and watching product cycle after product cycle and success after success. So you're really looking for footprints or fingerprints more than being able to kind of assess it. It's not something that you can walk down to a company, look around, see all the people, and say, aha, they've got great engineers. It's again something that you kind of discover and build conviction in over time, watching companies work through product cycles.
Do you think that the great opportunities find the talent, or do you think the talent finds the best opportunities?
Well, I think it's a combination, and it becomes a virtuous circle. So great engineers want to work for successful companies. Successful companies need to attract great engineers to continue to be successful, and that's a cultural thing. And again, that's something very hard to find in the 10Ks or the 10Qs or annual reports. It's something that you can only gain conviction in by watching over time.
Very good, Whitney. I want to remind everyone you can check out this interview with Whitney George by following the link beneath this video. If you'd like to send a question to Whitney, you can send it to editor@sprottmedia.com. Whitney, I want to thank you very much for joining me. The conversations are always extremely educational and enjoyable. And as the article says, 15 years at the helm. With the cumulative annualized GPA of 11.2, Whitney. As I mentioned to you before, that's Dean's List material, so congratulations on that.
Thank you, Albert. You're too kind, but it's always a pleasure to speak to you.
All right, take care.
Take care, Albert.